I am Associate Professor Lee Pinkowitz. I'm Associate Professor of Finance here at McDonough School of Business at Georgetown, and also the Associate Director of Student Engagement at the Center for Financial Markets. I am really pleased to be, moderating this panel on the future of digital assets, and want to introduce our panelists very briefly. I will give them a chance for 60 seconds, 90 seconds to introduce themselves afterwards. We have Dan Gallagher from Robinhood. We have Sarah Olsen from JP Morgan, and Haimera Workie from FINRA. Dan, if you wanted to kind of provide a brief self-introduction, you're on.
Sure. Thanks, Professor. Dan Gallagher. I'm currently the Chief Legal Officer at Robinhood. I'm on the board of Symbiont, relevant for today's discussion, on the board of the National Association of Corporate Directors and an advisor to Rally Road. Before all this, I was at the SEC for a long time, where I actually worked with my co-panelist here, Jaime, for years. And so happy to be reunited with him on the panel, and excited to be here.
Well, I guess, Jaime, since you got the shout out, why don't you go next?
Sure, I'd love to. So I'm Haimera Workie. I head up FINRA's Office of Financial Innovation, and our group was really created about 3 years ago to kind of serve as a facilitator for innovation in the securities market in a manner that's consistent with our overall mission, which is investor protection and market integrity.
And Sarah.
Hi, everyone. I'm Sarah Olsen. I lead corporate development for Onyx by JP Morgan. Onyx is a group within our investment bank at JP Morgan focused on blockchain technology. We build out solutions ourselves. However, I predominantly focus on investing in blockchain infrastructure companies and looking for external companies in the space to partner with to meet the needs of our clients. I'm a little bit of a weird hire for a bank. Prior to this, I joined from a cryptocurrency exchange. I worked for Cameron and Tyler Winklevoss, where I led corporate development for Gemini. That was a pretty interesting seat, where we launched the first regulated crypto derivative. We launched the first regulated stablecoin. We acquired an NFT platform several years ago, kind of ahead of the sort of the NFT space. So it's been interesting being kind of a crypto person, joining a bank and looking at digital assets from that perspective now. But the most important part about my background is I am a very proud Hoya. So I graduated from the college in 2009.
And Dan also is a proud Hoya, I assume, right? I'm at least attributing pride to you. How about that?
Very prideful.
Okay, fantastic. Sarah, actually, with that introduction, maybe the first thing that would be helpful here, and Jaime, I'll send this to you, which is sort of what is the difference between digital assets and sort of blockchain, right? And what are the different types of digital assets, as a way to sort of kick this off? Any thoughts?
Sure. So maybe to draw an analogy to an area people are more familiar with, if you think about it in terms of like an operating system that may exist, where there be one by Google or maybe by Microsoft, and you think about the apps that are on those various operating systems. Blockchain is really kind of the operating system itself. It's the platform under which you operate. And the digital assets are an app or basically a function that exists on the blockchain. So really a digital asset is a record of a real or virtual asset, one that's native to the blockchain, on the blockchain. So it's basically just a record that sits on the blockchain. But it's important to draw that distinction because people kind of associate things, like Bitcoin being the blockchain. It's not. It's basically it's a record of an asset on the blockchain. And then talking about different types of digital assets, there's a lot of different ways you can slice that. There's the one I just mentioned, which is if something's native to the blockchain, meaning that it only exists virtually on the blockchain, or if it's a tokenized asset, meaning it's a physical asset or some other type of assets that exist elsewhere and is represented on the blockchain. There's looking at different types of digital assets, for example, NFTs, or things are viewed more as commodities, things like Ether. From my vantage point, sitting at a securities regulator, really the distinction that we draw primarily is a digital asset a security or not? And if it is a security, there's a certain set of rules and requirements that apply, and if it's not, there's others.
Sarah, you had mentioned, you're sort of a weird hire from the bank in the sense that you could have came from a crypto exchange. And so, we're seeing this connection between or I guess collision between digital assets and real assets. If you wanted to kind of talk about either your experiences there or build on what Jaime mentioned, I thought you might have an interesting perspective.
Sure. I think what we're really beginning to see from a high level is this sort of bifurcation, and then kind of what I consider to be public blockchain infrastructure versus private blockchain infrastructure. And so when folks talk about public blockchain infrastructure, really what they're talking about are these permissionless systems that anyone can interact with. And so Bitcoin is what you consider to be public blockchain infrastructure. Same with Ethereum. What's cool about it is you only need access to the internet to be able to participate in these economies. And that's everything from being able to transfer value to, adding upgrades to these operating systems to be paid from these networks for maintaining them through things like mining and staking. And that's kind of phenomenal because now we have this sort of global permissionless network that anybody can take part in, and including transferring value, as an application that Jaime mentioned. But that's also really problematic, right? I mean, we're on the phone with regulators and lawyers right now, and we have and our financial activities in this country and globally are highly regulated. So the question is, what's the appropriate intersection between, kind of crypto or public blockchain and then leveraging this technology to create, highly permissioned systems. And, I think that, the question is, are we going to have an internet or lots of intranets? I think it'll be the former, and I think that banks will need to figure out kind of how to best intersect with these public networks. But right now it's very, very complex. And so you see almost this friction between, do we create sort of our own permission blockchain in which we're only selecting the participants, or, do we think more creatively about how we can, leverage this public infrastructure to best use, these new types of applications. So I would say from like the highest level, that's kind of the friction that I'm seeing right now between kind of crypto and institutions.
Okay, Dan, Sarah mentioned being on the phone with regulators and lawyers, of which you were sort of both, and then now we're on the other side. What is your kind of view on this? Either what Sarah has mentioned in terms of where this is heading, and maybe the different hat you wear than you did as a regulator.
Sure. Well, I think Sarah was spot on. And I think, the additional friction that she was getting at, I would say, is coming from the unregulated world, right? So from some of the platforms that don't have any regulated entities, either banking, brokerage, or other, who are really accelerating their growth, accelerating their product offering, and bringing more challenge to the traditional players. And I would say, at Robinhood, we are, strangely enough, despite the fact we're a big disruptor, we've changed brokerage, I would say, rather completely on the self-directed side. But we're part of the traditional system in the sense that we have regulated brokers. Jaime is one of my regulators. FINRA lives with us, the SEC, we have state regulators, and so on. And so when you're a regulated entity trying to adapt to this new reality that Sarah was talking about, it makes it even more complicated. You can't just rush into whatever makes the most sense. You have to take on board what your current regulators might think of this new technology. In this current environment, it's a lot of uncertainty, right? You have Chair Gensler at the SEC. It seems like in every speech or media appearance makes some reference to crypto or digital assets more generally. Sometimes throws cold water on it. Sometimes there's a glimmer of sunlight, and, without a real regulatory process, a real rulemaking out of the SEC, legislation coming out of Congress, and don't hold your breath there. It's kind of like shadow boxing, and, you get in, if you're Robinhood, you have, we have 22.5 million active customers. They're very interested in crypto. We have a very limited offering, and they want more and more product, but you have to be very careful and deliberate. We said this in our last earnings call, that you can't just be tacking on new coins if the next day, by some fiat, a regulator is going to call them a security. So it's a very tense situation in that regard, and it does call for regulatory clarity, which we haven't seen yet. And just one more piece, not to go on too long, but I think some amount of time, and maybe even 4 years worth of time, I think was lost to fraud in the market. And, you know, I'm very close with Jay Clayton. I think he was a terrific chairman of the SEC. When he walked in, whatever his views of crypto or digital assets are, and I know he has very, very positive views of the infrastructure, DLT and blockchain, they changed the minute he walked in because he was dealing with overwhelming fraud in the ICO market, and no one's going to debate, right? There was just massive fraud, and he had to deal with fraud, and to deal with fraud, you use your enforcement program, and when you use your enforcement program, sometimes you create bad policy on the edges, but putting that aside, there wasn't a real, you know, sober time to sit, study it, and come out with a regulatory paradigm that works. So we lost time due to that fraud.
Well,
yeah,
Dan,
if I could just add to it,
go ahead,
what Dan
please.
was saying, you know, I think it's probably important to start off with the understanding kind of what the regulatory landscape is for digital assets right now, right? So you have, if a product is a digital asset and it qualifies as security, there's, as I was mentioning before, there's a specific set of rules under the federal securities laws similar to other securities that would apply in that context. If it's not a security, it potentially falls into being a commodity. And the spot market for commodities, meaning that not futures or derivatives commodities, that market has limited federal oversight. The CFTC does have some enforcement powers there, but there's no federal functional regulator there. So there is this desire to potentially fall within that bracket, so that that oversight is potentially not as robust as it otherwise would be. I think when people talk about kind of, you know, the fragmentation of the digital assets regulation, it's important to understand that there's that area where there isn't as much regulatory action going on. Now, if you're looking at the futures for things like Bitcoins or Ether or things like that, that would be regulated by the CFTC, but the spot market doesn't have as much regulation there. There's some state regulation that applies in that context. And I think this is where kind of some of the concerns are about, you know, where investors, or even for the marketplace itself, if there isn't a framework around how it's supposed to operate, it potentially doesn't enable the building of enough confidence within the system, or potentially opens the door for other things that, as Dan was describing, fraud or other things to get carried out.
I do want to challenge the regulatory framework a little bit, and it is complicated in the US, where we have this bifurcated system where we have securities that are regulated by, you know, one body, and commodities, predominantly commodity derivatives, by another. But the issue with crypto is, you know, we've seen a lot of projects that can start off, you know, that kind of look and feel like a security, and then as they become sort of more decentralized networks, and you have more applications that are running on them, that then begin to feel like a commodity. And so you know, it's almost like Sorority's paradox. It's sort of, what point, you know, is this so centralized that this feels like a security, where you're essentially just buying equity in a company, you know, maybe run by whatever 5 people out of Silicon Valley, you know, and at one point, do we have this kind of autonomous operating system where you're really buying a commodity in order to use that? And I think that it's very difficult for early projects that need to be able to, I wouldn't say necessarily from like a capital raising standpoint, but really from, you know, having other projects use their protocol to write new applications, and having those incentives be correct. It creates a really complicated economic structure. So again, you can have something that, like, at one point looks like a security, and then everything kind of goes right, and then 6 months later it looks like a commodity. And the question is, you know, is that okay? You know, and how is that transition regulated?
Given that, and what the three of you just sort of discussed, and I recognize we're not going to create a regulatory regime on this call, but Dan, what, like, if you were trying to say, like, what would be the ideal regulatory path, at least in your view, that the U.S. should undertake to, I guess, to sort of be successful and yet control aspects of fraud and protect investors? Any thoughts on that?
Yeah, so instead of talking about what would be ideal, I think, take a chapter out of the history book and say what would not be ideal. And what did we see after the financial crisis, right? In Title VII of Dodd-Frank, you had the derivatives market, right? A lot of blame was placed on the derivatives market, some rightfully, some not, for the financial crisis in '08. What you got out of Title VII of Dodd-Frank was this intensely prescriptive framework for regulating derivatives, right? Formerly OTC derivatives will now be exchange traded. To Sarah's point, you have shared jurisdiction over those very derivatives between the CFTC and the SEC. You have two regulatory regimes set up for it. And when you look at it, it's a lot like existing futures market infrastructure on the CFTC side and equities market structure on the SEC side. So you took what regulators do and what policymakers do is they take something they think works and they overlay it in a new market. And coming at crypto, coming at digital assets, digital securities with this like better mousetrap design of let's just overlay the equities markets onto it. Let's overlay existing structures. I don't think will work. I think trying to replicate a lot of the inefficiencies that exist in those very markets. I mean, the equities markets are, whenever you're an SEC commissioner or a former one, you have to say they're the deepest in the world and our capital markets are the envy of the world. You've heard that a million times. And they are, despite massive inefficiencies built into them and opacity and other things. No one would, if they had a clean slate, build our US equity market structure the way it exists today. So let's not overlay that into digital securities. Let's recognize the efficiencies that come with this new technology. So my caution to regulators, policymakers there is resist the temptation to try to overlay what you know and be creative, work with the industry, right? Work with the folks who are using this technology to great effect today, with great efficiency today, to come up with something lighter touch, but that, to your point, Professor, gets at the fraud issues, gets at the core investor protection issues. You can do that without regulating in a very prescriptive way.
So Sarah, you were sort of talking about it's a bit of an odd ecosystem in terms of this. So if you, and this is not lobbying or anything, but if you had suggestions, what would, what should be the direction, right? So light touch, sure, but what is there a direction we should be thinking?
Yeah, like these are the types of questions that get you fired at a bank when you're not like a when you're not like a lawyer or regulator. So I've got to be careful. But I echo what Dan was saying, where I think that we have to be really creative, and we have to create we have to create policy that makes sense for the technology. And so looking at, the crypto industry, has all these sort of idiosyncratic problems, and it has a lot of bad stuff going on right now, right? Like, we have fraud, we had ICO fraud, I think we're seeing a lot of fraud in the NFT markets right now, unfortunately. I think that we're seeing, even just from the technical design of smart contract platforms like Ethereum, we see almost built-in market manipulation through being able to front run trades on DEXs. The concept of flash loans, which, again, is a weird, sort of a weird exploit of a smart contract that doesn't exist in the kind of analog traditional world. So, just to name a few, and again, these do need to be regulated. I mean, people need to be protected from these types of activities, but it needs to be, again, it needs to be in parallel with the technology. So we can't look at what we did sort of 50 years ago for something that kind of looks like this. We have to really kind of better understand the technology, and says, kind of what is the goal of this technology, and how can this technology, hurt users, and what's the best, regulation. And then also, when's the time to kind of, I don't want to say not regulate, but, what are appropriate sandboxes for people to experiment in? And then as they evolve, get to a place where they have more consumer protections.
Jaime, there's a chat. And I wanted to get your take on this too, but I also wanted to. Kirsten in the Q&A is asked, do you see the path forward being using the existing regulatory structure? Now she's mentioning SEC and CFTC, right? I'm just thinking, from your seat in FINRA, what is your view on this? Is Kirsten's path, or the suggestion, may not just the question, is that existing infrastructure going to work, or do we need to think something else?
So maybe I'll just echo part of what Sarah and Dan both said, which is that we do need some form of regulation for the parts of the market that are potentially not subject to full panoply of regulation. So, right, so for example, the President's Working Group recently came out with a report on stablecoins, and it had some recommendations around there about potential legislation, other types of actions that can take place. I would note that similar to the analogy that Dan drew about kind of the swaps market, and kind of the development of legislation around swaps after the financial crisis, you do have a segment of the digital assets world, specifically the spot market for the commodities, that's not subject to full panoply, at least federal regulation, right? So there is that is the space where things like that are more susceptible to happening, right? So, and I think it's important to at least first acknowledge that. And then once you acknowledge that, then talk about, well, what is the best way to bring that under the regulatory umbrella, where it's laying over the existing regulatory structures, which I think both Dan and Sarah agree is probably not the way to go. But what is the appropriate way to go? And how do you go about thinking about measuring what risks are in the system with the potential benefits that can be accrued? And making sure that you're also creating a level playing field so that, traditional financial system, as opposed to the digital asset DeFi world, are operating in a way that you're not having regulatory arbitrage between one and the other.
So I guess to push a little bit of this and make sure I get Kirsten's question precise, because the back part of it is, is it possible? Should we be creating, or should we be thinking about creating a new regulator for crypto, right? Or does that just broaden the scope of potential regulatory arbitrage here?
Yeah, I would probably say that's probably beyond my pay grade, but I would note, that what we as regulators are trying to do now is, given the current authority that we have, trying to figure out the best way to go about kind of having regulation over that. And for example, specifically within the security space, within digital assets that are securities, right? And everything may not always be perfect, but I think what we're trying to do is take a measured approach, where we are trying to leave room for operation of that market, but still have a way that the underlying investors are protected. And as as I was pointing out earlier, you had a number of ICOs that were issued, a number of them with fraud that were interwoven with them. They were being issued similar in the same way that you'd raise capital in a securities offering, without kind of having the mask of having a technology that didn't take into effect what you're actually doing from an economic standpoint. So, and I think there's a realization, there's a need to fight against that. But I think there's also a realization, at least, on a lot of regulators' part, that want to leave a room for this market to have the benefits that it could potentially apply to investors and others as well.
So, Jaime mentioned DeFi. Sarah, certainly this is a buzzword, and the Economist is talking about it, and we often, or maybe not often, so I think about it as, oh well, this is going to disintermediate financial institutions, right? What is DeFi, and how are conventional banks kind of embracing it or not?
Sure. So DeFi stands for decentralized finance. So you'll hear crypto folks talking about DeFi versus TradFi, for traditional finance. And DeFi can encompass a lot of different activities that you can have with value exchange on a blockchain. But from the sort of most simple kind of perspective, when Bitcoin was launched in early 2009, the technology was pretty phenomenal, from having a decentralized ledger where you could transfer value to, anyone all over the world, just provided that they had, access to the internet. But that's kind of all you could do. You could send Bitcoin to someone, they could send it back to you. But the capabilities were, somewhat limited, and even the Bitcoin network has recently just had some major upgrades. But even still recently, there's been limitations around what Bitcoin can do from a value transfer standpoint. And then if you kind of go forward, sort of 5 or 6 years, to sort of the invention of smart contract platforms like Ethereum, now we have ways to program in, the conditional transfer of value that makes, the transfer a lot more creative. I could say, I will send you, Ether if it's raining, and pull from a weather index. I can say, I will send you Ether if you send me DAI or, wrapped BTC or a variety of other digital assets. But what we've seen in terms of this kind of first evolution of DeFi is what are known as decentralized exchanges. Coinbase, Gemini, others, those are what known as centralized exchanges. They take custody of customer funds, they're matching trades, clients are able to, buy and sell that, but that exists sort of on their platform. And these companies kind of control that exchange of value. Decentralized exchanges, those happen all on a blockchain, and those are governed by smart contracts. So you can show up to a site like Uniswap today and make a trade, and there's no central counterparty. If I'm looking to, sell ETH and Dan is looking to buy ETH, we link up our wallets, we execute we basically, authorize this agreement to enter into the smart contract, and that value transfers programmatically. So there's no, there's no sort of person or institution that's sitting in the middle of that trade. And that's pretty phenomenal, right? That you don't need a central clearing party to exchange value, and you're doing that on a peer-to-peer basis. It also makes it really complicated in terms of like who's regulating that, who's responsible for ensuring that like the smart contract is written appropriately, that there are no security flaws. Today you don't need any KYC AML, so you can go and exchange value and not know who your counterparty is. So it's very complicated. And then the sort of other applications, some that exist and some don't, that is using this technology to do other things that we've seen in finance. So that could be writing an insurance policy on the blockchain, that settles to a weather-linked index. And so now we have like a cat bond market that it can exist on a blockchain without needing an insurance company or any regulator overseeing that. Lending has become, a major activity through smart contract platforms. Again, you're talking about technology that can really disintermediate traditional players, but at the same time, we have to think about ensuring that there are appropriate consumer protections, because there are some of the same concerns that you have with traditional financial activities, and now there's this whole new set of concerns that you have around using this technology. And that can even just be from like the technology not functioning well. We've seen major hacks in decentralized markets where people have, just lose all of their funds. That doesn't happen when you show up to JP Morgan to make a trade. So it's really, really cool, and we're right on the frontier of what DeFi is. But this really true like permission decentralized financial technology is the applications are really endless, but also like the kind of issues that come with it are kind of feel endless at this point because they're so new.
Dan, I'm wondering, I recognize Robinhood has got sort of limited on the crypto space, but given what Sarah has been talking about, and we've been talking about the regulatory side, but in a decentralized world, I'm curious what your views are. It doesn't have to be your official views here, but what sort of responsibilities would retail companies have? It doesn't have to be Robinhood, but in terms of people who are providing access to these types of investments, what are the responsibilities they have if there's sort of no central regulator?
Yeah, I mean, and again, it goes to this distinction, I think, that I called out earlier between sort of traditionally regulated entities like Robinhood as a broker-dealer, providing this as an ancillary service and an affiliate, versus the fully unregulated world, right? The folks who are very studiously avoiding, or they thought they were avoiding at least, any trigger, listing a coin that will become a security, right? I tell folks, once something is deemed a security, it's like that hot potato game you played as a kid, right? The security is the hot potato, and everyone wants to kind of throw it to the next person, because if you hold the hot potato, then all of the registration requirements and other regulatory requirements around securities Sorry, someone set off their car alarm outside my window here. All of those trigger, right? So one day I'm just an innocent person standing there with my hot potato. Next minute, I'm a broker dealer because I'm offering to buy or sell that security. I'm an ATS because I provide a market or an exchange, God forbid, right? If my blockchain allows for clearance and settlement, kind of like what Paxos is doing, then I'm a clearing agency that requires registration, and on, transfer agent, potentially investment advisor, and all the other registration categories that come with it. And that's an impossible situation right now. And so folks are trying to avoid, buying and selling or offering these securities to customers because they don't want to trigger all these requirements. They don't want rescission rights. They don't want all these other parade of horribles to associate. And so the folks who are very careful about it, end up as at Robinhood with a very limited offering. Folks who are less careful are adding coins, hand over fist and running that risk. Regardless, just as a corporate player, if you're a good corporate player in the space, you're going to provide some protections to your customers, whether you're regulated or not, right? Because at the end of the day, the customer can choose to walk, right? It's the Wall Street walk. I guess this is the crypto walk. They can move to a platform that has more transparency, reliability, it's safer. But that's the private market working now. And, I don't think there's, compelling or really vibrant disclosure about those sorts of protections that customers find important. So it's a bit of a free-for-all, unfortunately, and I didn't get the chance, and I'm like salivating to talk about the new regulator question. I know that Jaime jumped in. Absolutely not. One of the stupidest ideas I've heard in this space in a long time, and it just doesn't make sense. So folks who've been in this world for a long time know. Well, first of all, Jaime knows how much I like to pick on Dodd-Frank. So Dodd-Frank cites all these reasons that the financial crisis was caused, not failed federal housing policy, which was the real reason, or loose money, but all these other things. And one of the things was sort of redundancy and regulation and too many agencies, the alphabet soup of Washington. So Dodd-Frank set out to limit the number of agencies and provide clearer jurisdictions. So they got rid of one agency and added 3. So we ended up net 2+ after Dodd-Frank, and with even more confusion about jurisdiction. So the idea of adding a new regulator is just plain silly. I think you obviously would need legislation. And then I sit there and think, well, gee, I think of the poor congressional staffers drafting out legislation that says, here's this new regulator. It will regulate things that are commodities and securities at some point, but the SEC and the CFTC will have no jurisdiction over those products. It'll be just this new regulator. It makes no sense. So, let's get serious about this. And what needs to happen is hard work needs to be done at the SEC and CFTC with, I would say, and Jaime will like this, appropriate input from FINRA, because they're so key to all of this, to create a regime with existing authority. Like I said, that's light touch enough that recognizes the benefits of the technology, right? Sort of the cryptography, everything that comes with the blockchain, the auditability of the blockchain is a regulator's dream. It's built into the system. It's how things work. So let's leverage that. It's doable. You can use it with exemptive authority that the regulators have now. You can use it with the rulemaking authority. That's the best path there. So sorry, I had to jump in on that one. It's just too juicy.
Jaime, did you want to add on to that or respond?
No, I think Dan
Okay.
is a great vantage point now, because he's no longer a regulator, so he can apply away.
And Jaime knows me. I'm not like a jurisdiction builder. When I was at the SEC, I thought we should merge with the CFTC. I still think they should. It's silly. So I see Sarah smiling because she called that silliness out earlier. The fact that Dodd-Frank didn't do that when it set out to clean up the alphabet soup is like laugh out loud material. But yeah, I wouldn't be sitting around trying to figure out how to grow my jurisdiction at the SEC. The jurisdiction is real, and some of these instruments will be securities, some won't, and you have to kind of take into account, entities in a regulatory framework that allows firms, companies, enterprises, individuals to be in a market where sometimes it's a security, sometimes it's not, sometimes it's a commodity, sometimes it's not, right? And not worry that there's going to be some gotcha that comes after you post facto.
So given that, let me try and combine a couple questions here out of the Q&A. Joseph Canepa was talking about when you're talking about public infrastructure, does it entail the blockchain turning into the future internet platform, right? But I also think Dan Trosh has asked, what happens to traditional banks that don't adapt, and what does adapting look like, right? Because if you were talking about, should we be building our own infrastructure? Should we be using public infrastructure? What does it look like for banks to adapt? And given what Dan and Jaime were talking about, I guess more Dan, what are the concerns there for banks in terms of this?
Yeah, I think from sort of thinking about these questions, and I'll sort of reiterate that these points are very much so my own. But yes, I think we are going into a new era of the internet that is going to look and feel materially different than what we've been used to. And I think that if we build this the right way, it's going to be so much better, from a user standpoint. And so a lot of different industries are trying to sort of co-opt the term Web3. It's definitely one that I want to co-opt as a blockchain person. But really, what Web3 from a crypto standpoint refers to as, an internet that has native banking rails sort of embedded into the internet itself. And this is kind of how the internet was supposed to evolve. So when you hear people, when you hear Mark Andreessen talking about Netscape in the 90s, and the fact that we should have really already had this functionality, and we didn't, kind of the internet 1.0 and even 2.0 has had sort of banking and payment rails laid on top of it from the e-commerce standpoint. You haven't had value run through it. And now with these new capabilities, you're going to entirely re-architect the economics of the internet. And so we're no longer going to be sort of the products ourselves, like we're going to be users, and we're going to be able to control things like sort of privacy, be paid for consuming advertisements, being able to be tipped for our content, being able to tip others. It's going to be a really interesting dynamic economy that's going to empower the individual. And I'm really, really excited to see where that goes. With respect to sort of where do banks fall, and do they need to adopt this technology? Yes, absolutely. And I think the biggest mistake I've seen with banks, is talk about, blockchain is really just like a kind of a new, like a next generation of technology or another tech choice, because it's not just that blockchain enables, banks to digitize value. Like, you don't need a blockchain to do that. Like, value is already digitized at the central banking level, at the commercial banking level, at apps like Robinhood and SoFi and PayPal and others. What blockchain has redone is really, again, re-architected how we think about value. And so this is really a new technology unto itself. And I think that traditional institutions really need to, they don't have to embrace every part of it, but they really have to think about, where is this going to be disruptive for our business, and where can we best add value to this ecosystem? So I'm a big believer that institutions that are not just paying attention, but really building towards this future and being thoughtful about where they're going to fit are going to fall behind.
Yeah, and if I could just jump in there, I really think we're very much in the early innings of this thing. It's probably the beginning of the first inning, really. You've gone from just a few years ago where many financial institutions or larger financial institutions were saying, kind of digital assets are fool's gold, to coming around and to seeing, wanting to serve clients who want to have exposure in this space, and to, having a presence, whatever, in this space as well. And you've gone from, kind of the private networks and public networks to various forms that let you kind of pull digital assets from one, basically interoperability that let you pull assets from one to another. You have new types of blockchain networks like Solana. They're being brought out that has the throughput that something maybe like the Ethereum blockchain network potentially wouldn't have. That allows you to kind of do a very large number of transactions within a very small amount of time, similar to the throughput that you may have like in a NASDAQ or a Visa. So you have all these various changes that are going on all at the same time. And I think it's undetermined where all that's going to progress and what that ultimately is going to look like. But I do think that it's something that most financial institutions now, they're at least keeping an eye on, if not actively looking to see, is there a way that we can get involved in a way that's keeping with kind of the best interests of their clients, as well as the regulatory requirements that exist out there.
I would follow on to that, though, that the innovation is exponentially speeding up. And so it's, I think what we're going to see is, yes, we're still very much so in early innings of this technology, and so much so that we don't even quite know what it's going to look like. But the pace of innovation is accelerating, and because you have a global network in which anyone can participate in it, the innovation is, by definition, exponential. So I think that it's
as a regulator trying to keep up, I'll definitely agree with that.
Right. I mean, it's almost impossible. I mean, we're talking about, ICO fraud from a couple of years ago, and then you see kind of what happened in terms of the CryptoPunk being, the wash trading with the CryptoPunk for $500 million a couple of weeks ago. And that's a problem that literally could not have existed like only a couple of years ago. And so it's, it's tough for regulators. But it's also, again, it's just, but from a technology standpoint, like from the seat that I get to have, it's unbelievably exciting because, again, every year brings sort of more and more innovation. So, I think that it's the let's sit back, wait and see what happens approach is like that. That's not for the winners. Like that people who do that are going to be people or institutions who do that are going to be significantly disadvantaged, because by the time they kind of get to a place that they're comfortable, this technology is already going to look like something else.
And I think we have like a minute left. So Dan, I'm going to give you the last word. Maybe you can tie this all together, because right, Sarah has just talked about the pace of innovation, and we started with regulation, right? How fast do we need to a new regulatory structure to allow traditional finance companies to innovate, so that they are, places like Robinhood are traditional broker dealers?
We needed it probably a couple of years ago. So I think, Sarah's right. I mean, and Jaime's right. The pace is just incredible. I think what we need is, not a sandbox. I always hate when you say sandbox. I don't even know what that means anymore. It sounded like a great idea 5 years ago. It didn't really get us anything here in the US, at least. I know there's some, and Jaime, I don't want to offend FINRA when I say that, but you're so dependent on what the SEC is doing in that regard, that it's hard for you to have a fully vibrant sandbox. I think what we need is just a process, and we've heard Chair Gensler at the SEC say, come in and talk to us. I know the staff and FinHub at the SEC is very receptive to talking. We just need some guardrails, some guidelines, right? Of just like, good firms, regulatory compliant firms who operate in the traditional world, who are used to this intense regulatory climate, so can come in, seek the right relief to do this in a very safe way for retail investors in particular. We need that. We need some sort of bat signal up in the clouds to draw folks in, and we're getting a little bit of it. I just think we need something a little bit more clear, and we need it ASAP.
Thank you. Actually, thank you, Dan and Jaime and Sarah. We could go on for a long time here. There's some really great questions, and that I apologize for not getting to all of them, but I really appreciate your time and your expertise. Thank you all so much. This was fantastic.